Hey guys, it is Patrick with Financial Grit Media. If this is your first time watching one of our videos, make sure you press the subscribe button and turn on those notifications so that you are alerted every time we post another challenge video or a knowledge video to this channel. Now, I'm super excited about this video. This is our first challenge video that we are posting on Financial Grit Media. We'll be releasing some other videos that kind of explain in a little bit more detail our challenge video, but this specific video is all about our first challenge video, and that's our $150 challenge, where I take $150 invested into 4 index funds every single month, and hopefully we can do this together for 30, 35, 40 years, and we'll talk about some of the goals of this challenge if we do it correctly. So that's what we're going to be talking about in this video. Now, usually we would talk about the technical analysis. We would look at the fund, how it's doing, and we will also track that to the particular indexes that it tracks to. But since we are in our first video, we're going to be talking about making that first trade. So we don't have really any technical analysis here. I'm going to go through and show you the trades so that you can kind of see what's going on. Now, before I jump right onto my computer here and show you the trades and talk a little bit about what we're doing from our perspective of investing, I want you to know as a disclaimer that although we are talking about investing and maybe what types of investments you should invest in no way is that investment advice. So make sure that you talk to a qualified professional before investing any of your money into the stock market, and understand that there is a risk by investing. We assume that we're going to be making money for the next 30, 40 years, but in reality, there will be times where we will lose money, and there will be times when we will make money, and what we're trying to average is a 10% return on our money. That's what we're trying to do, but know that there is risks involved. So if we happen to slip up, or if I happen to slip up and tell you a stock or tell you an index fund, it's not because that's what I want you to trade in. It's not investment advice. It really merely is used as an illustration to what we're talking about in these lessons. So with that, we're going to go to the computer and talk a little bit about our trades right now. Okay, welcome back. You should now be seeing my entire screen. I'm in your right hand corner, and we are going to go through these slides that I put together to help you understand the investment philosophy of what we're doing with the challenge. We're also going to talk about what the funds mean when we talk about funds and actually taking our money and throwing it into these 4 funds. And then at the end of this, we're going to be talking about our goal, what our goal for this challenge is. So to get us started, let's talk about investment philosophy. So what is the investment philosophy that I have for this $150 challenge? Well, to get to that, we're going to talk about where the inspiration comes from. So the inspiration comes from a series of videos that I went through with Dave Ramsey and the Financial Peace University. And in those videos, he talks about how you should get your debt squared away, not have any debt, live debt free. And then at the very end, he talks about investing. And the reason why he talks about investing is because he knows that his audience members may not be sophisticated enough to understand investing. And so he wants to teach them investing, basic investing, nothing, advanced or anything, but just the basics of investing, because a lot of those audience members may not play in the stock market or may put their money in their 401k and then just do whatever their employer tells them. So he wants to empower them with information. And so what he tells his audience members is to do this with the money. When you're investing, put 25% in a growth fund, 25% in a growth income fund, 25% in an aggressive growth fund, and 25% in an international fund. So that's what he tells his audience members. So that's kind of the inspiration for what we're doing here. Is we're going to take 25% and we're going to put it into 4 funds. Now, that's an oversimplification of what we should be doing, because you would have to then find a growth fund, growth income, an aggressive growth fund. And a lot of times these funds like to make their name one thing, but really do something else. And so what we did was make it even simpler for us, for me, and put 25% in one of these 4 funds. And these 4 funds are small cap, mid cap, large cap, and international. And we'll talk about the kind of the easiness of this in a minute, but at the end of the day, we're going to be putting some of our money in smaller companies, some of our money in the medium-sized companies, some in our large companies, and some internationally. And so that's what we're going to be doing. So, what we're trying to do is kind of emulate a little bit what Dave Ramsey says, but at the same time, use these categories of small, mid, and large caps, because at the end of the day, later on, what we want to do is also track the difference in returns between small, mid, and large caps. So that there's really 2 reasons why we're doing it. One, because these are interesting, and another reason is because it can provide us data on truly what's happening with small, mid, and large caps using money that we have invested today, not a historical standpoint. Okay, so that's our challenge investment strategy. Now, for a lot of you that are watching this, you might go, well, I don't know what you mean by small, mid, large, and international. So we're taking some time right now to help you understand these. So what are small caps? Well, small caps are funds that favor companies at the smaller end of the market capitalization range. So examples of this would be like Grubhub, EPAM Systems, Exact Science Corp, and Nextar Therapeutics Inc. You might not notice these companies, don't know what they do. And that's because they are in part a small cap company, or a small capitalization company, because they are smaller. Now, if you don't know what market cap is, well, market cap is the number of shares the company has outstanding multiplied by its stock price. Now, essentially what a market cap is a market cap is what the market believes the company is worth. So if we take their shares outstanding times their stock price and we get $1 billion, then the market believes that company's worth $1 billion. That's not how much revenue they bring in. That's not how much expenses they have. That's not how much profit they have. That's not how much they distribute to their investors. There's more of a complicated calculations for all of that. But the market believes the company's worth $1 billion. So if you wanted to buy that company, you would have to at least start bidding at $1 billion. So that's what market cap is. When we talk about small caps are those companies that are smaller in nature and not bigger. So they're a little bit more risky. With more risk, we would expect more reward. So smaller companies, small mid caps, okay? Sorry, small caps, not small mid caps. Small caps, okay? The next one that we're investing in is a medium cap. And medium caps are funds that invest in stocks of various sizes and mixed characteristics. They're typically your middle of the road profile type of companies. Example of companies like this would be Progressive Insurance Corporation, SunTrust Bank Inc., Ross Stores, and Synchrony Financial. Now, you might not necessarily know all these, but they're somewhat, you may know their brand. In some parts of the country, you might know SunTrust Bank. In other parts, you don't, because they don't have any banks there. Ross Stores, you probably know because they're nationwide. Synchrony Financial, they're kind of behind the scenes. You might not know them, but if you have a store credit card, it may have been through Synchrony Financial. Progressive Insurance, you probably know Progressive Insurance through just insurance companies that are out there trying to sell you insurance for car, home, and a bunch of other things. So these are middle-sized companies. They're not maybe big behemoths, but they are middle-sized companies, mostly profitable, but they are not the big companies that if a wave comes, that they won't be hurt by that wave and have to figure out financially how to ride that wave. So they are a little bit more riskier than maybe the big behemoths that we're going to be talking about in the large cap index funds. So large cap index funds are funds that invest in stocks of big companies. Examples would be these ones here: Apple, Microsoft, Amazon, Facebook. You know these brands. So these brands are big companies, and because they are big companies, typically if some wave comes and hits them, they're kind of like an ocean liner. They may move a little bit, but they're kind of still going straight in their direction of movement. Some would say that their profits are predictable, their revenues are predictable, so they're big behemoths, so there's less risk in them because they shouldn't go bankrupt just like that, whereas a small company may go bankrupt the next day because they've got themselves in a financial bind. So that's our large cap index funds. So those are the funds that we are investing in, and typically those three, small, mid, and large caps, are US based companies. Now, 25% of our challenge money is going into international index funds. With international index funds, these are funds that invest in foreign companies. Now, depending on the strategy of the fund, it could be large or small companies. So here's some examples of companies that an international index fund may invest in: Nestle's, Toyota, Royal Dutch Shell, Shell Gas, HSBC Holdings. You may have some HSBC banks here in the United States, but they're generally, if you go to London, HSBC will be right around. You'll know HSBC when you go to the United Kingdom and just get off your plane. I think there's a ton in London Heathrow Airport advertising there. Okay, so that's international, self-explanatory, companies that are based outside the United States and not in the United States. So hopefully that gives you an understanding of what we're investing in. Now let's talk a little bit about their trade. Now, one thing to note is, because we don't want to influence you, I've masked all the symbols, I've masked all the descriptions, so you don't really know what I invest in. And that's only so that our people that are watching this do not take it as investment advice. So I apologize for that if you're like, I want the investment. But we do not want to artificially inflate prices because people are watching these videos. So again, no symbols here. And we'll talk about them from a high level. So here is the dashboard on Charles Schwab. So I use Charles Schwab. This is not a commercial for Charles Schwab, but I use their platform because it's just something that I've used for a very long time. So I'm very comfortable with it. I could have used any brokerage account really, but I've chosen Charles Schwab. You can choose whatever company that best fits your needs and your fee structure that you want from a company. So I've used Charles Schwab. So as you can see on 129.18, we did 4 buy transactions, and you'll see the quantity of stock that we got, or shares of these index funds, and then the price. There were no commissions, and so the index funds that I purchased through Charles Schwab's had no commissions, and that's a key. We'll talk about that in another video about fees and how they impact your overall returns. Now, there are fees in the index funds itself, but the trading fees, there were no any there. And then as you can see, the investments were $37.50 straight down the board. So there's hopefully proof of actually purchasing $150 worth of shares in this challenge. So here's the first one here. This is kind of the transaction detail. Again, I've masked the security number and the QSIP number, but this is a small cap index fund. We made the trade on the 29th. It settled the next day. We bought 1.176 shares at $31.90. So the amount that we invested was $37.50. So if you take $37.50 divided by $31.90, you get one share, 1.176 shares of the small cap. The next share that we have is a mid cap. Again, same information, other than we paid $42.09 for this instead of the 31 that we did with the small cap. Notice we only got 0.89 of a share this time, so we got a fraction of a share because it was priced higher than what we could put in. And because it's an index fund with Charles Schwab, we're able to do this. This is not an ETF. Okay. If you don't know what ETF, we'll do a video on ETF later on. All right. Large cap, we bought 0.875 a share. Again, this price was $42.88 instead of underneath $37.50. So we got a fraction of a share here, no commission again here. And then finally our international is priced at $22.16 at this point that we bought. The quantity that we received was 1.692 of a share. So almost 2 shares there, again, $37.50. So if we look at the big picture, again, here's what we have, and the market values and the quantities. And on the right-hand side, you'll notice that it says percentage of accounts, and they're fluctuating between 25. That's because this is a couple days old, so there has been a little bit of gains and losses, and so it's reflected there. But as you can see, it's 25% of our entire account. Cost base is $150, so now you know we are in it for $150, just like we said this challenge would be. All right, so that's what it looks like. Those are our trades. Hopefully that's good enough evidence for you if you're wondering if we're actually putting $150 into it. We are. So let's talk about our goals here. So what are our goals? Now, really, we don't have any goals. The goals is hopefully to make money and to hopefully educate people like you on the importance of investing just a little bit in the stock market or a little bit in your retirement account so that you can live the life you were meant to live at the end of the day. So we're using kind of historical trends here when we're talking about the goals of this challenge. So we're going to take the average. The average market return is 10% over a long period of time. Now, some would argue that it's less than 10%. Some would argue it's more than 10%. We're going to use 10% because that's an easy round number. And I hate adding things that aren't round. Not really, because I can use a calculator, but this makes it easy, 10%, okay? So we're gonna use 10% here as our rate of return. And I know as a fact that these funds on average, since its inception, have not been achieving 10%. They've been achieving about 9-ish or 8-ish, or don't have any inception percentages right now, and that's okay. We're gonna say 10. We're gonna try to hit that 10, and if we don't, we don't, but hopefully we're close enough to 10%. So, in 30 years, we want to try to hit $311,462 at a 10% of return. I know that's 30 years. That's 2048. But hopefully we get there, okay? And hopefully I'm still doing these videos. So in 30 years, we hope to have $311,000, investing only $54,000. We'll talk about compounding later on in another video. I know we're telling you that we're going to do another video, but this is really just a challenge video. But $54,000 we're going to invest in over a 30-year period of time, $150 a month. We hope that it grows to $311,000. Not bad at all. If we take a look at 35 years, our goal is $500,000 and only investing $63,000. And then in 40 years, it's going to be $72,000 in investment to hopefully have $840,000. I don't know if I'll be alive in 45 years. I hope that I am. If we get to that, we should be over $1 million, and we'll have a big party, video style, if that's the technology that's still there in 45 years. Who knows? But hopefully that's what we do in 45 years, is we show you in 45 years what has happened to this $150 a month. So that's our goal. That's what we want to do at the end of the day, is we want to grow this money 10% in the stock market. We may not hit it. That's okay if we don't. If we hit half of what this is, it's still not bad either, because $72,000 investment and we would have 440 is still not bad. Now, for you economics people out there and wondering about inflation, I haven't adjusted this for inflation. This is strict dollar amounts. I haven't taken into inflation at all with this, so sorry. Okay, so that's our goals. That's what we're doing. So although this video is not that exciting because we're talking about like helping you learn stuff, that's the point of this video, is to help you learn, help you understand. Know that $150 can have a very big impact 30, 40, 50 years from now. And we are taking the tortoise approach. We are not taking the hare approach. We are not trying to find a quick rich scheme. We're trying to find a slow, steady, consistent savings amount in the stock market to try to get to $1 million in 45 years. So with that, I hope you enjoyed this first challenge video. I know there wasn't any technical analysis, but hopefully as time goes on, we can show you that technical analysis, and I can show you how $150 can make a huge change in the future. So with that, we will see you in the next video. Oh, before I do that, make sure you like, subscribe, share this video so that other people can be attracted to this and also be excited about investing just a little bit. Hey, and if you have a comment, you have a question, leave that in the comment section below. Hey, if you want to join in and you want to invest a little bit in the stock market yourself, I'm not going to tell you what to invest in, but I want to know about that. So put in the comment that you're all in. You're going to grind it out just like we are, putting some money into your retirement or whatever account and investing that consistently every single month. So with that, we will see you in the next video, next challenge video or the next knowledge video that release here on Financial Grit Media.